Hello friends, how are you doing out there today? I hope the market's treating you well and you're able to navigate your trades through the market very efficiently and effectively. This is Vijay Bambwani, and in my video today, I'm going to try an attempt to answer your question about where the Nifty is likely to go in the calendar year 2021. Two requests. Please try and bear with me for the background noise of the construction that's going on in the building next door. And secondly, I will admit that I'm not very good at making long-term projections for traders on something as volatile as the headline index. So we are guesstimating here. We are trying to attempt to rein in a tiger, which is not going to be a very easy job, and nor is it laser precise. So in my recent videos, I've been saying that the market is far from a bubble. And will there be a crash? I said there will be a corrective fall, but not a crash. And in this video, I'm going to kind of narrow it down to attempt to give you a broad band of where the market is likely to be headed. Now, what we saw once the lockdowns were imposed last year was that the headline indices made a low, and now I'm referring particularly to the Nifty in the spot segment. It made a low of 7,511 in the week ended 27th of March 2020, and the very next week a rally got triggered, and this rally has been a spectacular, stupendous, fabulous, fantabulous, call it what you want, a rally that has delivered more than 100% in less than a year, because in the week ended 19th of February 2021, the Nifty made in the spot segment a high of 15,432. Now, as you can see on your screen, what I have done is plotted a weekly chart of the Nifty in candlestick patterns and very simply plotted a Fibonacci retracement ruler. Now, this is something that even amateur technical analysts will be able to identify very effectively. As of now, I've taken the bottom at 7511, which of course is established and activated. A top of 15,432. If at a later date the top is overcome and a higher top is made, you need to adjust the Fibonacci ruler to the new top. But for now, 15,432 is the top that I have taken. The bare bone or the bare minimum correction that you can expect in the market as per Fibonacci levels is 38.2%. Now, this is a standard operating procedure, and this 38.2% is at approximate levels of 12,400. Now, this would 12,400, I'm not saying it's necessarily coming, or if it is coming, it's going to stop there. Now, remember, we are guesstimating. Now, at 12,400 also, this would still be a valid correction. It would not count as a bubble bursting. You have often seen a correction of 38.2% in individual stocks, currencies, bond markets, and definitely in equity and index futures. So up to 12,400 would be a valid correction. And as we speak, as you can see on this chart, the 25-week exponential moving average is at 13,775. As of now, that's not even tested. So let's not call this a bubble bursting. It would be too kind of premature. This is an ongoing correction, as I would call it. And only after this 25-week exponential moving average is violated. And remember, as the price progresses day by day, the 25-period exponential moving average reading will go higher, because the price, even though is falling, is still higher than 13,775. And this EMA, or the exponential moving average, will gradually edge higher. Of course, at some point in time, it will touch the price, and if the market falls deep enough, the exponential moving average may be violated, which is why the Fibonacci ruler is a better yardstick as compared to a standalone exponential average. And the rally, if it was to sustain, on the other hand, so far we have only seen where the declines can come up to. The rally, if it can sustain, and I'm taking a pot shot, an estimate for the calendar year, not the financial year, the calendar year 2021, it has the potential in an extreme optimistic scenario, if that was to occur, between 17,200 to 17,500. Now, I'd like to break this down into the trader's psychology. I have noticed whenever I have used the words careful, caution, I've got negative feedback saying you're bearish on the market. And similarly, now that I'm saying that it's a correction but not a bubble bursting and the markets are not in bubble zone, I'm noticing that there is resistance to the idea. Of course, it's a free world. You are more than welcome to agree to disagree, or even disagree and disagree, even violently so if you want, in the comment section. I welcome all your feedback, because the behavioral technical trader in me keeps marking a tick mark or a cross on a mental spreadsheet that I maintain of a subscriber or viewer feedback that helps me gauge the mood of the market. So go out there and log your feedback, positive and negative. Now the problem occurs when I give you such ranges and give you broader kind of outlook of bubble, not bubble, correction, crash, whatever. The problem occurs when you start looking at things from a very short term or maybe even an intraday trader's perspective. The same problem is something I realized in my call on gold. While I was talking about gold in end of calendar year 2021, which I even went and extrapolated to the end of calendar year 2022, people started responding to it as if these were trades. Now do remember, when you trade, you basically leverage. When you're leveraging, you're using borrowed money or OPM, other people's money. I call OPM as a pun, OPM as in a narcotic, and OPM as in other people's money. Now the fact that you can take leverage positions by paying maybe 10 to 11% in an index future and 16% in a stock future, and therefore multiply your returns, people tend to forget that even the losses tend to get multiplied. So a trader basically gives it his or her all into a day trade. And I'm hearing horror stories about how people who've recently lost jobs or their businesses aren't really doing all that great, etc., are even borrowing money on their credit cards to pay margin money in the market and trade. Now, obviously, those kind of traders will get very grievously hurt in a market scenario where the downside projection of the Nifty is open up to 12,400, but the upside projection is open up to 17,200 to 17,500. Now, if you're basically a scalper who's playing for 10, 20, 30 points for the Nifty, these wide ranges can be extremely intimidating. Which is why you need to basically sit back a little, take a longer term view and see where the markets are going and align yourself in the overall bigger picture of the markets. Yesterday, I saw flashes of a very old movie, a Hindi movie called Sarkar. And Amitabh Bachchan, the mega superstar of India, was telling his son Abhishek Bachchan in the movie, do not forget the long-term threat perception when you are chasing a short-term political gain. You know what? We traders and investors need to imbibe this philosophy even in our short-term trades. Look at the longer-term picture before you even take a shorter-term trade. This is what even Warren Buffett says. Do not buy a stock even for 1 minute if you think the long-term prospects of this stock are not good. So before you trade, do keep the longer term picture in mind, which is why I keep saying in all my videos, be careful, exercise caution, And if you join Equity Masters Telegram channel, which I think is a must-have in your trading inputs, the handle is Equity Master Official. I keep warning my readers that the statistical beta or the pure price volatility is at highs where retail traders frankly cannot handle. To be very honest with you, there are days when the statistical beta is so high that I sit back in my chair and say, boss, I'm not trading today. This is far beyond the risk levels that I'm allowed to take on my statistical model based on the Jensen's measure. Jensen's measure is when taking on one additional unit of risk returns one additional unit of reward or more, ideally more, otherwise the trade is not to be taken. And as of now, the Jensen's measure is screaming for you to be absolutely careful. Am I calling this a market crash? Not yet. I stand by my hypothesis in the previous videos where I've said it's a correction, the markets have overextended, but it's still not in bubble zone. The declines will be sharp like I've mentioned, but the ranges are with you. Do not over speculate. Do not even speculate, I would say. And borrowing money on credit cards or paying interest to pay span margins or initial margins is an absolute no-no. This is the best way to commit financial suicide. I'm sure you, my viewer, are much more smarter than that. On this cautious note, I end this video, not before reminding you to click like on this video if you agree with what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh content being put up here. In the comment section, do keep the lines of communication open. Positive, negative, all feedback is welcome. Help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Have a very, very profitable day ahead. Vijay Bambwani signing off for now. Thank you for watching. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.